if you have told your class that this session has begun, we shall not be waiting for anybody moving forward. It's wrong to wait for people. You shall always keep time. You shall always keep time, always. So there is this question that we were doing in our last class that we never completed, which I would want us to complete today. Very interesting question. Was it Viruga Limited? Viruga Limited, that is April 2025. April 2025. Question number what here? 4. Question number 5B. Question number 5B. Welcome, Viruga Limited. So the online students, once you get it, I to say the online student, Viruga Limited, once you get it, please say yes. The online students, once you get this, please say yes. We shall be happy. They've said yes. All right. A friend of mine is saying here that she's really tense because of tomorrow's Brazil versus Argentina. Very good. So it has even confused me. I wanted to know what I will. Yeah, great, great. Yeah. So we continue. Viruga Limited, we are told Viruga Limited is an unlevered farm. So Viruga, no debts. That is basically the meaning of what here somebody unlevered, no debts. The farm expects to generate EBIT of shillings 20 million each year in perpetuity. So EBIT has been given. The farm's current market value is 120 million and it pays corporation tax at what rate? 30%. So, ladies and gentlemen, this automatically means that it is, I mean, if they want me to use Modigliani and the Miller to do valuation, now that they have given me tax, this will be MM what? This will be MM2. Because tax is provided. So that automatically becomes MM2. The management of the farm is considering the use of debt financing. The farm's financial analyst has estimated that the present value of any future financial distress cost to be 80 million. And that the probability of financial distress would increase with leverage according to the following schedule. So, the gentlemen, remember, debts may make you to be what here? Distressed here. The higher the debt, the higher the probability of you becoming bankrupt. Yeah, the higher the probability of you becoming bankrupt. So whenever they talk about distress, they want us in this case here to use MM3. So if you remember very well, this very question, we are done Roman 1, we are done Roman 2, and now we are doing Roman what here, somebody? Roman 3. We are doing Roman 3. The online students, most of them have not made an announcement to their colleagues that, hey, this session has begun. The online students, ladies and gentlemen, please do me a favor by telling your classmates. I know there was a confusion. There is somebody who went ahead and said that this session was to start at 10. No, it normally starts at 11. 11 up to what time? 2 p.m. 2 p.m. And for your information, I normally take Saturday, the Saturday class, which you normally use for AMA. Yeah, the 6 p.m. Once I've gone very well with the AMA syllabus, I normally drop that session for AFM. So from the coming week, we shall be having AFM on Saturday from what time to what time? 6 p.m. Online and physical. Physical, yes. So we have an AMA class at what time on Saturday? 6 p.m. to 8 p.m. We have it. So now we shall no longer be having AMA at that time. We shall be having AFM. So please put that in your calendars. It's very, very important for you to know that. So now we are dealing with MM3. MM3 is about bankruptcy. It's about financial water distress. Look at Roman 3. The firm's optimal level of debt financing using Modigliani and Miller with corporate taxes and financial water distress. So then how do we get the value of a levered firm whenever we have a financial, distress and the tax is involved? So this is an extension of MM2, which somebody must have forgotten. Is there somebody who is able to remember MM2? What is the formula? Value of a levered firm equals? Charlton, for one, you've forgotten something, right? Value of a levered firm will be equal to value unlevered plus DT, debt tax. This basically is what we call the tax shield on debt. Tax shield on debt. Is that okay? Tax shield on debt. So that is MM2. That is MM2. And then now we have MM3, which will be, we are also in this case encouraging you to take higher debt amounts. So value of a levered firm will be equal to value of unlevered plus again D what here somebody? DT. But now this time around there is a warning that, hey, the higher you go, the more value you will lose in terms of distress. You'll start getting so many calls from auctioneers. So you come and subtract present value of expected bankruptcy or financial distress costs. Financial distress costs. So remember, this expected distress cost must be in terms of present value. They must always be in terms of present value. They must always be in terms of present value. Which question? Thanks, Kerubo. I should have written it here. So you guys give me this. It's supposed to be which city? April 2025. I had forgotten to write it up here. 2025. Question number 5. Be like that. Thanks. Thank you. So whenever you hear of MM3, always remember this will be used to give us to ascertain value of what here somebody? A levered organization. So if you give me this kind of a question, then how do I tackle it? So to tackle this one is quite an easy thing. I simply need to come up with a table here. I simply need to come in here, and then I develop a table. A table which will be able to help us get this. So we start straight away with debt. Because you see, the financial distress is about debt. So are you able to see the debt figures given there to us? 25, 50, 75, 100, 125, 150, 200. All right. So whenever I see this debt, the first thing that I will do is to get the tax shield on debt. Tax shield on debt. What basically we call D what here somebody? DT. Ooh, my table. Ooh. No, I don't like this. It's not good. It's bad. Let me do the right thing. Yeah. So tax shield on debt. Basically what we call the DT. So as this examiner given us the tax rate, yeah. What is the tax rate? 30%. Tax rate is 30%. So then debt times 30%. Already we have done this in our last class, if you can remember. Already we had done this in our last class, if you can remember. So you're able to give me this tax shield on debt, the DT. The first one I'm being told by Charlton. This man with a unique name. 7.5. 15. 22.5. 30. 37.5. 45. 60. 60. All right. But now remember, we have present value of expected. Present value of expected what here? Financial distress costs, FD. Present value of financial distress. Call it financial distress. To make it very easy, are you able to see the present value of financial distress, ladies and gentlemen? Inakuja namna gani, somebody? No. That's probability. And I want money. I want money here. Kenya shillings. Present value is money. How much do you have there? 80 million, isn't it? 80 million. Read that question very well. Read that question very well. So that is the last, before the table, you can see there the financial analyst has estimated that the present value of any future distress cost is what here? 18 million. And the probability of financial distress. So the 80 million will not fluctuate. It doesn't matter how much debt you have. The 80 million, that will really be the present value. But you see, what we want, ladies and gentlemen, is the expected present value of distress. Expected means what here, somebody? Probability is involved. Expected means probability is involved. So expected PV of FD. Fortunately, for each debt level, they have given me the probability to be involved. For each debt level, they have given me the probability of financial distress. They have given me. Like the first one, you can see the probability is 0. The second one, it's 0.0125. Then we have 0.025. Then we have 0.0625. Then we have here 0.125. Then we have here 0.3125. Then lastly, we have 0.750. So then are you able to give me this expected? Expected means you are involving probabilities. Don't forget this. Expected means we are involving probabilities. Online participants are only 60 something. It's simply because we don't have very good neighbors here. A good neighbor will use an SMS, text a friend. I mean, we have this class. Please join now. Because this is a life-saving session. Very, very important. It can make you see play that you've never seen before. So the first one is 0. The second one? One. Remember all figures here in shillings, millions. Thank you, Sonny Ray. Wow, okay. 2. The third one, the fourth one, I mean. 2, I have that one already. 5. 10. 25. 16. Thank you so much. So now I want you guys to do me a favor. Come here under MM3. Now with your friend, give me value of a Liberty Farm. Whenever you hear financial distress, that is a levered organization being valued under MM3. So remember MM3, ladies and gentlemen. I just want to see whether you guys will be able to get. So remember MM3, we are saying that this is MM3. Value of a levered farm equals value of unlevered plus DT, isn't it? Minus present value of FD. And don't forget that this has to be expected, always involve probabilities. Yeah. So we start with the first one. Yeah. At this debt of 25. The first one is 25. So are you able to see value of unlevered farm? That one we were told from the very beginning there. That one we were told from the very beginning there, where they told us that Viruga Limited is an unlevered farm. Doesn't have any debt. The farm expects to generate EBIT of 20 each year in perpetuity, and the farm's current market value, which is unlevered, is 120. And the DT for this debt level, the DT for this debt level is 7.1. 7.5. The present value of financial distress is what here, somebody? 0. So then you can easily give me the value of unlevered, the farm of value of unlevered farm here. 127.5. 127.5. So please go ahead and get all the others. At this debt level 50. There is that. I got that. Oh, formula Chini, okay. All right. At the debt level of 50, then what do we have there as value of a levered farm? Oh, they're not talking to me. You see, 134, You see, like now here, I will start with value of unlevered, which will be the same, always, 120 plus DT for this is 15, minus the present value of this FD, which is 1. So I'm being given 100. So you continue like that until, in this case here, you get, where do you get the 120? If you read the question from the very beginning there, we are told Viruga Limited is an unlevered farm, and the farmer expects, so Viruga is unlevered, doesn't have any debt. You see, this BU means what here? Value of unlevered farm, which will be value of Viruga. All right. And you can see that Viruga in the second sentence, they are telling us the farm's current market value is 120. Ali, you've seen already that. All right. So now you're able to give me these values, all of them very fast. The third one, 134.5, 140.5, 145, 147.5, 140. And then now you can see in this case here we are going, we started from 127, we went up. So this is the apex. Yeah, so the 147.5 is here. This is the maximum farm value. So if you read the question very well, the question wanted us there to give them the farm's optimal level of debt financing using MM with corporate taxes and the financial what here is spread. So optimal means best. Best is the one that gives us the biggest value. Yeah, so the best, so the optimal value optimal value is 147.5, and therefore optimal debt will be equal to somebody here. Now you go with this. Optimal debt is this one, isn't it? 125. And you have answered the question. Million. If you wish, you can put the millions, but just like me, I will not even bother. So of course, I've done that question from right at the middle. I'm so sure that many of us have been able to follow, but please, for the sake of our syllabus coverage, I would kindly request that we get to move on, right? We get to move on. We get to move on. And I want us to try August 2024 under the bus. Okay, no, that was a very easy question. August 2024. This is the one that the examiner threw students under the bus. Under the bus. August 2024 was marking this sitting. It wasn't a very nice question, this one. Most students here were thrown now under the bus with this very short question, but many students do not get this right. So what is the name of the question? Always tell me the name of the question, please. August 2024. Palm Limited, eh? It is August 2024, question number 3A, B. I'm told it's Palm. So when it's Palm, I can go here. This PDF of mine, now I'll be able to repeat the question. Technology is very good. Yeah. So all of us have been able to get this one. Eh? Yeah, this one really the 4 months, so not many students were able to get anything there. Palm Limited shillings 12.5 billion of equity capital and shillings 2.5 billion of debt capital, all at current market values. They're not book values, current market values. The cost of equity there is 14%, and the cost of debt is 8%. The company is planning to raise 2.5 billion by issuing new ordinary shares. It will use the money to redeem all the debt capital. So they redeem all the debt capital. What does that mean to us? All equity finance. So it becomes unlevered farm. Using Modigliani and the Miller proposition, determine the cost of equity of the company after the debt has been redeemed. Assume that there is no corporate tax if the company issues new equity. MM1, isn't it? Yeah. Let me give you a minute. You think through it. They do it. I'm so sure here I have very serious needs. So the online guys, are you able to hear some echo in my sound, or am I okay? I'm trying a new sound system. I'm a man of new things. I try many new things. Others fail terribly. It's okay. Great. Very okay. Thank you very much. Thank you very much. Great. I'm happy. Check what your neighbor is doing. Like now, I'm checking what this lady is doing as in my immediate neighbor here. I hope you're writing something, right? Now, here we have some low-hanging marks. Okay, let me hear from you. Especially the online guys. I can see the physical guys are writing a few things. The online guys, shall I do the question immediately or shall I give you time? If I had only these physical guys, I would give them more time because I can see they are writing. But the online guys, I can't see them. I would want to get feedback from them. Are they writing something or should I do the question? Do it, Mwalimu, yeah. Do it, yeah. So there are low-hanging marks here. Low-hanging fruits, which I can harvest immediately. So they have given me the market values of my instruments. So they've given me equity, market value equity. How much is the equity market value? 12.5, isn't it? And then we have debt market value. How much? 2.5, yeah? So whenever you're given market values, always think about weights. It's a low-hanging fruit. I'll be able to get a mark there. So to get the weight, I need the total. So the total here will be what here, somebody? 15. And therefore, the weight of equity will be 12.5 over 15. Mm-hmm. 0.83. So weight of debt will be the balance, or simply 2.5 over 15. Or you take 1 minus 0.83, which will be 0. Thank you. Always use your calculator. Mostly they say 27. Always use your calculator. Thank you so much. And fortunately, this examiner has given me the current cost of equity. Has he done that? So the current cost of equity is telling me is what percentage there? 14%. Has he given me the current cost of debt? Which is what here, somebody? 8%. Yeah. And the moment I see the two things here, weights and the cost, so what should we do? Huh? Wakaka. Yeah. Do your name. WACC. You give us weighted average cost of capital, which will be weight of equity, cost of equity, weight of debt, cost of what year? Debt. Why am I not putting here 1 minus T in the brackets? Tax is 0, MM1, isn't it? Tax is 0. I don't have to bother with tax now. All right. So give me the current. So WACC will be equal to weight of equity, which is what here, somebody? 0.83 times cost of equity, which is plus weight of debt times cost of debt, which is 8%. Which gives us 12.98. So let me ask you a question. The WACC that we have here, is it for a levered farm or unlevered farm? Levered farm because there is what here, somebody there? So this is WACC for a levered farm. 12.98%. Now we have gone ahead. We have, in this case, here, been able to issue new shares. We've got a new capital and we have said we are redeeming all our debt. Now we don't have any debt. Now, after this, they want you to go ahead and give the examiner the cost of equity of unlevered farm. Please read the question again. I'm not trying to put these words in your mouth or in the examiner's mouth. If you read the required, using proposition, determine the cost of equity of the company after the debt has been done what? Redeemed. So I'll give you 2 minutes exactly, and I'm counting. It's 11:30. It's 11:30, Mary Ann. 2 minutes, Robakami. Please try your very best. Give me this cost of equity of unlevered farm. Try your very, very best. Please try your very, very best. Please try your very, very, very best. Please try your very, very best. Ui, Micheni Masi. Ui. Ui, I don't know. I don't know. Ui. Do nothing, please. Don't do a lot, please. Remember, under MM1, things don't change. Value of a levered farm equals what here, somebody? Value of unlevered. WACC of a levered equals WACC of what? Unlevered. Is that okay? Therefore, in this case here, the WACC of the unlevered is what percentage as well? 12%. And what do you know? You know that WASHU equals K. Nakumbuka kama hiyo WASHU equals K. WASHU equals K, and therefore cost of equity of unlevered will be equal to 12 point what here, somebody? 98%. So they never wanted you to do a lot of calculation there. They wanted you to use logic. They wanted you to use logic. They wanted you to use logic. So remember, after redeeming all the debt, Farm Limited will become an all-equity financed company under MM1 proposition without corporate tax. The WACC will remain always what you call constant. Yeah, or will always remain constant. So remember, MM1, we are looking at what we call Modigliani and the Miller first proposition. The one without corporate what here? Corporate taxes. Modigliani and the Miller. I believe with that, you guys have gotten some concepts that now you can write there and run with in an exam. April 2026, question number 3C. I always like doing the most current questions, especially for AFM, because I don't want this examiner to catch any one of us. April. If you want the very old videos, very old questions, you can go back to the 2 semesters videos ago, you get them. Question 3C. What is the name of that question? Yes. Baruga. Kamuda. You call it Bermuda or Bermuda, but we shall overcome. Ooh, not that one. I must have picked the wrong one. Not that one. It's not that one. It is one that has got Hamadad's model. We call it the Hamadad's. Question 2C. You sure? Question 2C, eh? Yeah, it is question number. It's Bellevue. Bellevue, right? So April 26, question number 2C. Thank you so much. Question 2C. So before I introduce doing of this question, please write there the Hamadas model. Amada's model. Amada's model. So this is a model or a formula that is used to ascertain beta equity of a levered farm. Beta equity of a levered farm. It's a model that is used to ascertain beta equity of a levered farm. And how do we get this beta equity of a levered farm? That our BEL will be equal to BEU into 1 plus D over E into 1 minus tax. Like on a formula big like so many guys have come this way and they were able to pass these papers. I mean, why not us? So anytime we want to get this beta equity of a levered farm, we should always use this formula where BEL is beta equity of a levered farm. BEU is beta equity of unlevered farm. It is also known as assets beta. Asset beta. It's also known as assets beta. Then, of course, we have D. D stands for debt. We have E. E stands for equity. And the T is taxation. T is taxation. So remember that generally, beta is a measure of systematic risk. You can write there like a note. Or first of all, finish writing. Or you're okay, okay? So you're saying here beta is a measure of systematic risk. Is a measure of systematic risk. Yeah. Then, of course, these betas, they are divided into two. We have what we call assets beta. So assets beta measures the systematic risk. These measures the systematic risk arising from the companies underlying business operations. Business operations excluding the effect of debt financing. So basically, whenever you hear about asset beta, it is that risk which is only associated with the operations of the business. So basically, asset beta measures what we call business risk. There is no gearing here. There is no financing risk there. All right. That's what we call asset beta. And then now we have the other one, which we call equity beta. Equity beta. So tell us there that equity beta measures these measures the systematic risk. systematic risk faced by ordinary shareholders. Faced by ordinary shareholders. That's why we are calling it what is somebody equity. Equity beta. All right. So after full stop, tell us there, it reflects both business risk. It reflects both business risk and additional financial risk. Additional financial risk arising from debt finance. Arising from debt finance. Arising from debt finance. Tell us there that it is also called the levered or geared beta. Or geared beta. That is why we are calling it BEL. Better equity what yearly? Levered. Better equity levered. Better equity levered. Very, very important for us to appreciate this. What I would want you to always know, whenever you hear about assets beta, please, as a summary, whenever you hear about assets beta, you always think about what here somebody business risk. And then whenever you hear anything to do with what here somebody equity beta, you always think about business risk plus who? Plus finance or financial risk. Very, very important for you to know that. So now we can read our question. The Bellevue question. Now we can read our question. The Bellevue question. Bellevue Manufacturing Limited is evaluating its capital structure to determine the optimal level of what year leverage. The company is currently financed entirely by what year? Equity. So meaning that Bellevue is an all equity finance company, meaning that it is basically unlevered. The information available regarding this organization is as follows. Number one, risk-free is 7%. 2, expected market return is 15%. Asset beta is 0.1 year. The corporation tax rate is what year? 30%. The company is considering introducing debt into its capital structure. The proposed debt to equity ratio is 0.5. Additional information, the cost of debt before tax is what is there? 10% per annum. The company intends to maintain the proposed capital structure permanently. Assume that debt beta is what here somebody? It is always 0. Debt beta is always 0. Using Hamada's model, determine the equity beta after introducing what? Test. Can I give you 1 minute to try the question? Using Hamada's model. Are you able to remember this Bell equation in this case here right away? Round one. Better equity of a levered organization. So in this case here, in the solution, we know that under the Hamada's model, Bell always equals Bell into 1 plus debt over equity into what here 1 minus section. All right. So then my good students there, you will be able to do what you straight away, you appreciate that concept. You will be able to see what is given there. Of course, we have BA. BA. BA is our asset beta, isn't it? So BA equals beta equity unlevered without any financial risk. Unlevered means no financial risk. And this beta equity unlevered, they've given us a figure of 0.9, isn't it? 0.9. Thank you so much. Are you able to see the debt to equity ratio? That has been given to us directly, isn't it? Are you able to see the taxation? Is it given? 30%, which is the same as 0.3. When you subtract now 0.7, isn't it? Therefore, beta equity of a levered firm will be equal to BEU, which is 0.9 into 1 plus the debt to equity has been given to us as 0.5 times 1 minus 0.3. So this will be the same as 0.9 into 1 plus 0.5 times 0.7. So what are they getting there? Somebody 1.215. So this is the equity beta. That beta, which has got business risk and financial risk. Very, very important. That is what the examiner wanted me to do for some 2 marks, 3 marks, if you ask me. Nobody gets it wrong. If you go to an exam and you're not able to apply Hamada's model, then automatically you're the only one who is getting it wrong. Nobody gets Hamada's model wrong. It's the easiest model in finance. Then now, with your permission, I'll be able to go to number 2. Using CAPM, determine the cost of equity after the change in capital structure, another free of charge marks. Nobody confuses CAPM. Nobody. Nobody ever gets it wrong. You can even try. If you get it wrong right now, I'm 100% sure you are the only one who is getting it wrong. Simply because you have forgotten the formula. Because all of us, we know Roman 2. All of us, we know that CAPM, no. All of us, we know that CAPM, so it will be CAPM cost of equity. All right, not CAPM returns as we are used. So CAPM cost of equity will be risk-free. Plus into brackets RM minus who? Do you remember that risk premium? Multiplied outside here by beta equity of a levered firm. Because now the firm is levered. The firm is levered. I'm sure we are normally used to beta, just beta, yes. Now this is cost of equity. All right. So this examiner given me the risk-free rate. Anasema ni 7, Yeah. How about returns of the market? 15%. Risk-free 7%. And then the bear that you guys got. Don't use the beta equity and levered up there. So many guys will use the beta equity and levered, and yet this organization now has got debt. So in this case here, 1.215, and you can see so many guys have already gotten the answer. A 16 point what here, somebody. That one, everybody would have gotten it right. That one, nobody would have gotten it wrong. I told you. Roman 3, they want me to give them the workup. Roman 3, they want me, thank you so much, Ali. Roman 3, they want me to give them the workup. I determine the workup after introducing who? Debt. Workup after introducing debt. Fortunately, I know the formula. I know that WACC will be equal to weight of equity, cost of equity, plus weight of debt, cost of debt. Here we have tax. So we must do tax adjustment to cost of debt, because cost of debt is interest, and normally interest is tax allowable. Normally interest is tax allowable. Remember, cost of equity is dividends. They are never allowed for taxation. So you see here, they have given us debt to equity is 0.5, isn't it? Not many students will be able to use this to get the weights. Whenever they give a debt to equity ratio and you want to get to weight, so many students will get it wrong. But myself, I know the secret. If they want me to give them weight of debt, what I will do, I will take the number that is given here, which is 0.5, all over the same number, but plus 1. That's how I get the weight of debt. It's called abracadabra formula. So if they tell you, for example, debt to equity, say is 8, how do you get weight of debt? You will take 8, you divide it by the same number, but plus what? Don't ask me where that one is coming from. Anyway, listen and listen to me very well. You see, you've told me debt to equity is 0. What here, somebody? You see, there is a hidden number here in the denominator. The hidden number is always what? 1. Meaning that debt here, please check what I'm doing. Debt is 0.5. Yeah. And equity is what here, somebody? Equity is 1, isn't it? How do we get weight of debt? It is debt over debt plus equity. And the debt here is 0.5. All over the debt again, which is 0.5, plus equity now, which is what here, somebody? 1. Which will be the same as 0.5 over 1.2. 5, which will end up giving me what figure, somebody has the weight of debt. They're already giving me the 0 point. And the moment I have weight of debt, what do you think will be the weight of equity? 1 minus this. 1 minus 0.3. That is the only secret. Once I know how to get weight of debt, whenever I'm given debt to equity, then that is it. I will be good to go. 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 That is it. I will be good to go. All right. Then, my friends, simply come here and do your substitution. Go ahead and do your substitution in the WACC formula. In the WACC formula, go ahead and do your substitution. So we know that WACC equals weight of equity, cost of equity, plus weight of debt, cost of debt. And this has to be after who? After tax, isn't it? So the weight of equity you have given me 0.67. Do you remember cost of equity? You got it using CPA, isn't it? And you had given me a figure of 16.72%. Plus weight of debt, this was 0.33. Have they given me the cost of debt here? 10%, eh? So 10% times the tax adjustment of 0.7 times the tax adjustment of 0.7 times the tax adjustment of 0.7. So they're getting some funny figure. 13.51, eh? Kidogo, okay. 13.51. So I can't know that is up to where. I don't know. Don't know whether that is enough. Thank you so much, Ali. Scroll down. I wish, Gladys, you could ask your colleagues to simply send you screenshots. It'll be easier. It'll be easier. It will be easier that way. It'll be easier that way. It'll be easier that way. The system that I'm using is not very friendly to this scrolling. Now, my very good students, please listen. Now, I'm taking you to something that not many people know. Amada's model, when a company is entering a new industry. Amada's model, when a company is entering a new industry, like RCM, for example. If you were to go, in this case here, for example, to alcohol business. Bad example, right? Bad example. But you see now that's a business which has a totally a different risk profile, isn't it? This profile is very, very different. Very, very different. All right. So I would want us in this case here to write a few things there. That when a company is investing in a new industry, we should not use the company's current equity beta because it reflects the risk of the existing business. The risk of the existing business. The risk of the existing business. Full stop. We should get a proxy assets beta dash there. This is asset beta of the new company. This is asset beta of the new company. Asset beta of the new company. So that now we get to understand in this case here, the business risk in that new industry. Case question, August 2022. August 2022, question number 2. August 2022, question number 2. August 2022, question number 2. Libre limited. When I know the question. Libre limited. Question 2A. Question 2A. Libre. Libre limited. Debt equity ratio by market value is 2:1 here about. The corporate debt, which is assumed to yield a return similar to treasury bill rate, is 10% before tax. The beta value of the company's equity is currently 1.1 here somebody. The average returns on stock market equity are 15%. The company is now proposing to invest in a project which would involve diversification into what here somebody new industry. Amanda's model, new industry. The following information is available relating to this industry. Average beta coefficient of equity capital is 1.6. The average debt equity ratio in this industry is 1.2. The corporation rate of tax is what here somebody 30%. So determine the suitable cost of capital to apply to this project. So they simply want us to give them WACC, but now here from Manen. Think through this question. Take like 2 minutes to think through the question. Actually, 5 minutes with your friend. Solution. So the first thing we need to do is to get to understand the business risk bill of the new industry. This industry we are going into, we need to know its business risk. We need to know its bill. This is what we'll get some books calling IE and gear, the new industry. Open it up. And gear, the new industry. Open it up and gear. Open it up to understand it. So here it means that you're getting beta equity and lever. So use Hamada's model. So at least get this 1 minute or 2 minutes to write the formula, the Hamada's formula. Write the Hamada's formula. Write the Hamada's formula. So great. So we know, ladies and gentlemen, that Hamada's formula, Bell equals Bell into 1 plus B over E into 1 minus what here, somebody? So what is the Bell of the new company? Remember, everything here, all new company parameters. New company parameters, all of them. So is there somebody who is able to see the better equity of this new company? Yeah, I can see the following information is available ready to the new industry. Average beta coefficient of equity capital is what here, somebody? So I can see the Bell for the new industry is 1.6. Bell is what I'm looking for. Are you able to see the debt to equity of the new industry? Yes. Average debt equity ratio is 1:2. So debt is 1, equity is 2. Debt is 1, equity is 2. So this gives me 0. What here, somebody? 0.5. And then, of course, tax is what here, somebody? 30%. So I can easily get this bill by substituting. So the bill there is 1.6 equals bill into 1 plus debt to equity. You've given me a figure of 0.5. 0.7. Because you see, 1 minus 0.3 is 0.7. 1 minus tax here is 0.7. So then if you're a very, very good student, could you kindly tell me, what are you getting in brackets here? What are we getting in brackets here, ladies and gentlemen? 1.35. 1.35. Thank you so much. So therefore, 1.35, no. BEU will be equal to 1.6 over 1.35. We divide both sides by 1.35. 1.1? 9. 1.1. So that is step number 1. Thank you so much. That is step number 1. Now from there, step 2. You regear the above. You regear the above using the existing company's capital structure. So we want to introduce the financial risk now using what here, our company. We have already known the business risk of the new industry. So you regear. Regear means what here, somebody, you get back with equity of a livered firm. Again, our mother's model. But this time around, you're using the existing company. You see, existing company is live. Existing company is live. So do you know it's debt to equity? Debt is what here, somebody for live. What was? 2:5. If you wish, you can put here 0.what here, somebody. 0.4. The existing Libe's capital structure, 0.4 like that. And then, of course, tax, we know it is 0.3. So 1 minus tax, 1 minus 0.3, gives me what here, somebody? 0.7. We are still using BEL. You may forget about everything that I've taught today, but you should always remember the BEL concept. So BEL equals who? BEL into 1 plus D over what here, somebody? E into 1 minus what here, somebody? T. So is there somebody who is able to give me the BEU? This is the one we got after, isn't it? 1.19. 1 plus. There to equity, you've given me a figure of 0.4. Yeah. 1 minus tax, we know it is 0.7. Like that. So they'll give me this BEL. 1.53. I'm told this is 1.52. So you regear. And regear. After that, of course, now you go to CAPEM. But before I go to CAPEM, I would want to know whether my online students, are they able to follow? You know, you guys are lucky because I can see your faces. I can see when you are start, like I can see when I'm happy. Your boss are great, my friend from Rwanda. Great. Thank you so much, Christine. Great. Now, you see the steps are very, very easy here. You gear, new industry. That's number 1. You regear using existing companies' capital structure, meaning that you get BEL. From there, you use CAPEM to get cost of equity. And then lastly, you give us what we call WACC. Those are the basic steps that we must always remember. BEL of 1. Explain. Yeah, very good. There is a BEL given there of 1.1, isn't it? So the BEL given here of 1.1 is the existing, right? The existing business and the financial risk, yeah, of this industry we are in. But you see now we can't go with it to the new industry. We can't go with it to the new industry. So that becomes what here irrelevant. That becomes irrelevant. That becomes irrelevant. You must always follow these principles. Whenever you read a question talking about new industry, you must always go through these basic steps. All right. So already now we are here. Now we want to go to CAPM, isn't it? So come here and they give us CAPM, cost of equity of the fund that is now relevant. So how do we get this? It is risk-free plus RM minus risk-free multiplied by beta what here? Equity, which is beta equity of a relevant. Like that. So in this question, are you able to see the risk-free rate? Yeah, 10%. So risk-free rate, treasury bill rate is a bit 10%. How about market returns? Yeah, you can see the average returns on stock market equity. Yeah, 15%. Minus risk-free, 10%. Multiplied by our bell. Our bell is what here, somebody? 1.12 like that. 1.52. Sorry for that. 1.52. So now you're able to give me this CAPM, cost of equity delivered, 17.6. Thank you very much. Now after that, you can easily give me the WACA. You can easily give me the WACA. So WACA, I will give you 1 minute. Please give it to me. Remember, you guys gave me the debt to equity. You told me for this one, it is 2 is to what? Yes, was it 2 to 5 or something? 2 to 5, eh? For this, you know, they want us to give them WACA for the new project, eh? WACA for the new project. So 2 to 5. So that is the case. Then you can easily give me the weight of debt, which will be debt all over debt plus equity. So the debt here is 2 all over 2 plus equity, which is, because debt is 2, equity is 5, isn't it? Huh? Yeah, just 1 minute. One minute. For the new project I'm being told is one. I know why. You see, this one is a 2. We only use it for purpose of what somebody at getting. Otherwise, when we go to this alcohol industry as the RCM, we are going there with our capital structure. Capital structure doesn't change. Our capital structure will remain at what somebody 2 to 5. Thank you for that. 2 to 5. 0.2. So the weight of equity will be 0.7. So the 2 must add up to 1. And please remember, also if you can recall very well, we had gotten debt to equity at 0.1. Do you remember 2 over 5 was 0.4? Yeah. So then if that is the case, if I was to get it from here, is there somebody who can give me the shortcut of getting this from debt to equity of 0.4? How do we get weight of debt? The shortcut, you take 0 point over 0 point plus 1, which will be 0.4 over 1 point, which will end up giving us 0.4. Meaning that weight of equity will be 1 minus 0.29, which gives us 0.7 what here, somebody? So whichever way, yes. Yeah. Michelle must remember, we are going, yes, into a new industry, but we always go with our capital structure. When we go to a bank to borrow, we go asking them to give us a debt as per our capital structure. So always, actually, I'm the one who brought this confusion because I was reading the question here. Determine the suitable cost of capital to apply to this project, which is new. Remember, this new industry information, you only use it the way it is for purpose of Anikia. Otherwise, moving forward, everything shall be as per our structure, capital structure. All right. So now our WACC will be weight of equity, cost of equity, weight of debt, cost of debt. All right. So now our WACC will be equal to weight of equity 0. What here, somebody? 0.71. Do we have cost of equity? Got 17.6%. How about weight of debt? Do we have KD? KD is 10%. Please remember, my students, that KD in the situation where you are not given KD directly, in situations where you are given risk-free rate, yeah, and the KD has not been given, always remember that KD will always be equal to what here, somebody? Risk-free. Because debt is normally secured. Yeah, debt is secured. For somebody to have a loan, yeah, he has to bring collateral. So that means that this should be a risk-free investment. A risk-free investment. So please always remember this. This is very, very important for you. Very important for you. Is that okay? Thank you. So then that we have been able to get this very, very well. And then I would want to invite you to now do your own question from the beginning to the very end. On this line, now from the very, I'll only be taking answers there. April 2025, question number 4A. This concept of new industry, it rarely misses new industry. Going to a new industry, rarely misses. Going to a new industry, rarely misses. April 2025, question number 4A. Please tell me the name of the question. The name of the question. April. Question 4A. Hakuna? Huh? I just got 4A. Wamekataa. Huh? Why do I get this question wrong? F? It's 5A. Movie. It's Jawabu Limited. It's question 5. Sorry for that. Why do I have these questions? Why do I capture the top? Question 5A. Jawabu Limited. Yes. Sorry for that. Jawabu Limited. So Jawabu Limited is 100% equity financed company. The company is considering undertaking a major diversification in the consumer electronics industry. Its current equity beta is 1.2, which is noise. While the average equity beta of electronics industry is 1.6, very similar to what we have done. Gearing in the electronics industry averages 30% debt, 70% equity. Corporate debt is considered risk-free. Additional information, expected return on the market is 25%. Risk-free rate is 10%. Corporation tax is 30%. Using suitable discount rate for the new investment, determine the WACC assuming Jawabu Limited were to be financed in each of the following what year ways. Were to be financed in each of these following ways. Let's hear from you. By 20% debt and 80% equity, by 30% debt and 70% what year equity. Just try your best. This is classwork. I'm not going to assist you anyhow. No assistance at all. I'll only be expecting answers. Fortunately, there are very many low-hanging marks. There are low-hanging fruit. Many of them. Many, many of them. So shall I do the question? We do it, eh? What are the online students saying? Shall we do the question together? The online guys, they are saying yes. They're saying yes, right? So, the best contribute is that Shalom. Thank you for bringing that up. We shall overcome. Like yesterday, we shall overcome. So then, in this case here, so always start with what you're somebody, the new industry. And then what are we doing here? We are ungearing, isn't it? I.e., get value of new industry. Of new industry. All right. So then in this question, you can see additional information. No? Second paragraph. These guys are going to a new industry, which is the electronics industry. So this new industry is the electronics industry. And I can see it has got better equity. Of course, it's levered there. Yeah. Its current equity beta is 1.2, while the average equity beta of electronics industry is what here, somebody? 1.6. And the gearing in the electronics industry averages what here, somebody? So debt is 30%. Is what here? The current one, isn't it? And then they have given me tax. Tax, what is the tax rate there? 30%, so 0.3. So one, not always. Very good question. Very good contribution there. It's 0.3. So therefore, 1 minus tax will be 1 minus 0.3, which gives me 0.7. Thank you. Now, ladies and gentlemen, once then I have this, I will be able to remember the Hamada's formula. So Hamada's formula, so we know in this case here, ladies and gentlemen, that Bell equals Beu into 1 plus D over E into 1 minus tax. So Bell for the new industry has been given, isn't it? Beu is what we are looking for. Debt, that will be 30 over 70. Eh? The percentages can cancel. Eh? Yeah. Times 1 minus T is 0.7. So are you able to give me what we have in brackets? 1.23 like that. No, I don't want the answer. I want what we have in brackets, please. 1.3. So in brackets here, we have 1.3. So up to here, you guys were really very correct, isn't it? Therefore, Beu will be 1.6 over 1.3. Yes. Yes. Yeah. Roman 1. No, it will be 20 over 80. Very good question. So remember, when we are doing this degearing or ungearing, we are using all information is supposed to be for what here, somebody? For the new, for this new industry, which is what here, electronic. Let's read in this case the first paragraph. We are told Jawab Limited is 100% equity by now. The company is considering undertaking a major diversification in the consumer electronics industry. Its current equity beta is what here, somebody? 1.2. That is the equity beta of which company? Jawabu. While the average equity beta of electronics is 1.68. And then the gearing in which industry? So you see, even gearing has to be gearing of electronics industry, like that. When you come in this case here to the required here, Using suitable discount rate for the new investment, determine the WACC assuming Jawabu. So they're giving you the capital structure of the existing company. The 20%, that 80% will be capital structure of Jawabu, which is the existing company. So that cannot be used here for the gearing. That cannot be used for the gearing. So then this gives us 1.2 here, somebody. Now the online guys up to here, are we together? Online guys up to here, are we together? Yes. Thank you very much. Now, after, in this case, here, ladies and gentlemen, have been able to ungear. Remember, I gave you the basic steps. Ungear, new industry. And then from there, what do? We gear, the above, using current company information. After that, in this case, here, you come and give a scale using CAPM. From there, now you come and give us WACC. So already you have been able to do the first part. That is done. Now we go to the gearing. So gear, this 1.23 using Jawabu's capital structure. So step number 2, gear the 1.23 using Jawabu's capital structure. So this was quite confusing. Yeah. So we have here Bell, Amada's model, equals BEU into 1 plus debt over equity into 1 minus what here, somebody? T. 1 minus T like that. So you see now, some students made an argument here and they said that, you know what? In this particular case, Jawabu is all equity finance. It doesn't have any debt. But now there was a catch one here. Look at, in this case here, Roman 1. No, first of all, copy up to here, please. There's no hurry in Africa. Copy up to here first. So here, the capital structure of Jawabu, not any other company, but capital structure of Jawabu is changing. We are changing it ourselves. So we are told here, using discount rate for the new investment, determine the WACC, assuming Jawabu Limited will be financing each of the following what here, somebody? Ways. So Jawabu Limited will be financed. So meaning that the capital structure of Jawabu here is 20%. So we have here debt is 20%. Equity is what here, somebody? 80%. So now give us that BEL. So it will be BEL, which is 1.23 into 1 plus debt is 20 over 80. 1 minus tax is 0.7. 1.44. 1.44. 1.44. 1.45, eh? 1.45. They're saying no. The brother is wrong. 1.4. So the online guys are able to get this 1.45. Yes. Once we get this, then we know that the natural partner, sister of Bell, is Kel. It's known as Kel. Bell and Kel, they rhyme very well. So you give us Kel using CAPM. And the CAPM, you know, it's risk-free. Plus RM minus risk-free. Now multiplied by what here, somebody? The beta equity of a levered farm. So do you have these metrics here? The risk-free is the final answer. Risk-free is 10%. Market is return is what here? 25, given Roman 1. Minus 10% multiplied by 1.4, of which Mary Ann has the final answer, which is 31.75. Hey, wanasema 17 wewe. is the correct figure. 31.75. Thank you so much. Because how, right? And then now the father of them all is a WACC, which is the cost of capital, which will be now used. So then this will be the weight of equity, cost of equity, weight of debt, cost of debt. But now this is after, this is after balance. And again, remember in an exam, you don't have to get everything. Here in KASNEB, we're not looking for people who are perfect. No. No. So long as you've got an idea. Problem is going to an exam and then you see nothing. You become blank. That is the only problem. But at least if you're able to get the formulas here and there, then you are above average. You are above average. So weight of equity from here, you see, we start with debt. 0.8. Well, 0.8. 0.8. So remember, debt over debt plus what here, somebody? Equity. So you're right. So the debt in this case here will be what here, somebody? 20 over 20 plus 80, which will be 20 over what here, somebody? 100. So basically that gives us what here, weight of debt of 0.2. Weight of equity of 0. You shall always use this approach. Even if things look obvious, always use this approach. You'll never go wrong. Use this approach, you'll never go wrong. So you're right. So weight of equity is 0.8. What about cost of equity? Plus weight of debt times cost of, we have cost of debt, the question. The risk-free rate, isn't it? The risk-free rate, which is 10%, times 0.7. So are you able to give me this WACC? 6.8%. 6.8%. Now try Roman 2 on your own. Now this one, you have to get it right. Try Roman 2 on your own. You'll get it right. Try Roman 2 on your own. I use that formula to get my D over E. Yeah, to get my D over E. E over E. You see, D over E, it will be 20 over E, which is 80. Please, everybody check this before you go to Roman 2. Before you go to Roman 2, you see D over E is 20 over 80, isn't it? Which gives us 0. I want us to get used to something here. 20 over 80 gives us 0.25. So if the examiner gave you D over E at 0.25, how will you get weight of debt? You will take, in this case here, this 0.25, you divide by 0.25 plus what here, somebody? Plus 1, which will be 0.25 over 1.25, which will end up giving us 0. Something. Please give me the answer here. I like how students are assuming this. 0.2, isn't it? And therefore, weight of equity will be 1 minus 0.2, which gives me 0.8. Which gives me 0.8. There's a question there, right? 0.8. So now I want you guys to try Roman 2. There's a question. I need to go back and have a look at it. Yeah. MMG, remember, 10% is debt before tax. And what have we done there? We have adjusted it for tax. We have adjusted it for tax. We have subtracted there 1 minus T. That's why we multiply by 0.7. Thank you, Pauline. Already students have gotten, started getting the final answer there. So Roman 2. You see, Bell will always remain the same. Bell will remain the same, regardless of how the capital structure looks like. Bell will remain the same. Stanley was Bell 1.23. Bell 1.23. So remember, in Roman 2, we have in this case here debt. What is the debt in Roman 2? 80%, 30%. And then equity is what here? Somebody 70%. So then we have here, I would want to use this weight of debt, 0.3. Weight of equity is 0. What here? Somebody 7. There is something I want you to see, all of you here. So when I'm getting now Bell, I know Bell will be Bell into 1 plus debt over equity into 1 minus what here? Somebody tax. So please listen. My Bell will be equal to Bell. Please check this. Bell is 1.23. So this debt over equity, I can still use weights. So if you get an examiner giving you weights, don't call me and tell me, Molimu, there was an error. If you come and take this weight of debt, which is 0. What here? Somebody over weight of equity, which is 0. You'll still get the same answer. You can work with the weights. Times 1 minus 2, which is 0. What here? Somebody 7. So are you able to get this Bell? 1.599, which is the same as 1.60. Yeah. Then go ahead and tackle on Kel. So Kel, how do we get Kel? It's CAPM, isn't it? CAPM. So this will be risk-free RM minus risk-free. Right. So risk-free, you guys are given me a figure, right? And RM, we also have RM, which is 25, minus RF, which is 10 times this Bell of 1.59, which ended up giving us what figure? Approximately 34%. Approximately, isn't it? 4%. So after that, WACC. So already we have the weights. So weight of equity, we have the figure 0.7 times cost of equity, which is now 34%. Weight of debt is 0.3. KD is, so then we have to do tax adjustment, isn't it? Because that somebody alluded up there, the 10% is before, 10% is before tax. So 5.25 point. Thank you so much. You guys have tried your best. I thought you would do the whole question on your own, but honestly speaking, I've ended up doing most of it, right? So let me give you yours, right? Renault Limited. Let me give you a question. Renault Limited. And this will come. I know things that nobody come. Everybody do many questions there. On those things that come, I get to do many questions. So Renault Limited is question 3C. Yeah? Question 3C for Renault Limited. August 2025. Question 3C. August 2025, question number 3C. Question number 3C. August 2025. Mimi nasema 3C na ni 3D kwa nimeanza kule. Aidha. Ni 3D. Ui. Lakini si uzeni baraka. Uzeni baraka. So 3D. Renault Limited. Renault Limited. So have they gotten the question? 3D. So have they gotten the question? Have they gotten the question? Thank you so much. So Renault Limited is the plastics manufacturer is now considering a new It's get you a new investment that you at the bottom of your thing without even knowing what I'm doing. Is now considering a new investment and will involve the investigation into chemical manufacturing, where the business risk is very different from the plastic manufacturing industry. Research has produced the following information about the 3 companies currently engaged in chemical manufacturing in the same part of the industry that Renault Limited is planning to invest. So XYZ. Additional information. Renault Limited is financed by 60% equity capital and a 40% debt capital, and would intend to maintain the same capital structure. The risk-free is 5%, and the return on the market portfolio is 9%. The corporation tax is 30%. Assuming that the debt capital of Renault Limited and companies X, Y, and Z is risk-free, calculate a suitable cost of equity for the proposed investment by Renault Limited in chemical manufacturing. Huyo examiner anatesa wanafunzi yake. Na yule ni wanafunzi wadogo miaka kidogo. Because you can imagine, like now here, he gave you an industry which has got how many companies there? X, Y, and Z. So imagine he wants you to get the industry fail. So he wants like an average for the 3. Not many students were able to reason like that. Hata tunashangaa tu examine anataka aje na hiyo wanafunzi. That kwa utafikiria wewe sasa. What are you utafikiria kwa? Dakika 5 kwanza think. And then I do it. It was a bit complicated, but you guys are also complicated. Let's I should do sophisticated. Yeah, let's try getting things we see. Let's try getting it. So remember, just a clue, because I know you'll be able to get this clue. So we are going to a new industry. Is that okay? But this new industry, you're seeing it has got 3 companies. So these 3 companies, what are we supposed to do? The first thing that a good student thought of is to anikia. So you should be able to anikia the betas of X, Y, and who? Z independently. 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 So I mean, you apply Hamada's formula in X, Hamada's formula in Y, and Hamada's formula in Z. When you have anikia, then you can add them and average. You can add them and then you average. Is that what we say? Is that what we say? Okay. We shall overcome, Stanley, don't worry. We shall overcome. So can we start with company X? So remember the formula is Bell equals Bell into 1 plus D over what here, somebody? E, 1 minus E, yes. So for X, are you able to see the equity of this labor term? For X. Equity beta for X is 1.33, even. Are you able to see the bill for X? That's what we are looking for. Is that okay? 1 plus D. This data. So 60 over what here, somebody? Equity, which is 40. Is tax rate 30% as our brother told us? Yeah, note number 3, tax rate is 30%. So then I multiply this with 0.7. We multiply this with 0.7. So go ahead and give me what we have in the brackets. So remember, BEU can be added, but bells can never be added. Eh? You cannot tell me, Molim, now get the bell, 3 of them. No, no, no. BEU can be added. So my rate tells me this is 2.05, isn't it? Why are we doing this? Remember, here we are looking at the new industry. And they have told us, ladies and gentlemen, in D paragraph 2, research has produced the following information about 3 companies currently engaged in chemicals manufacturing in the same part of the industry that Renault is planning to invest in. So those 3 companies are in the new industry. The 3 companies, excellent. So first of all, gear them or ungear them. So they're telling me that Mwalimu, BEU will be 1.33 divided by 2.05, which gives us what figure, ladies and gentlemen? 0.65. So are you able to do the same? Give me the one for Y and the one for Z, please. Please do the same and give me the BEU for Y and the BEU for what here, somebody? Then. So for Y, my brother Stanley is giving me 0.63. That is Y. Thank you so much, Pauline. For Z, 0.6. For Z, 0.6. I hope all of us are able to get this, unless you want one able to do it, to do each one of them. Z 0.62. Thank you so much. So remember the procedure that we are using here, very, very important. The procedure we are using here, and gear, betas of X, Y, and Z. That's number 1. Then you find the average assets beta, i.e. average BEU. Yeah, that's number 2. And then now you regear using Reynolds capital structure. Using Reynolds capital structure, then we calculate cost of equity. And then lastly, you give us our big brother here known as Wakapa. That is the procedure. So you gear betas of X, Y, and Z. Find the average assets beta, i.e. average BEU. And then the next step will be to regear using Reynolds capital structure. Yeah. And then you calculate the cost of equity. And then at the very last, you give us WACC like that. You give us WACC. Thank you so much already. Paulina has an answer. So come here and give us the average assets beta. So give us here average assets beta, which is the same as average BEU, which will be what here, somebody? 0.65 plus 0.63 plus 0.62, you divide by what here, somebody? which gives us 0.40 somebody 6. So already now, my very good students, we have been able to find the average assets beta, average BEU. Now please go ahead and regear using now Reynolds capital structure. .4. Yes, correct. Correct. So now we are regearing. So from there, regear 0.63 using Reynolds capital structure. Don't go to the new again. New, you have finished with it. Roman 1, we finished with the new news industry. So how do we regear? So we have here Bell equals BEU into 1 plus D over E, tax adjusted. So then this Bell will be equal to BEU, which is 0.63, 1 plus. So are you able to see the capital structure of Renault? And you can see in the additional information, Renault Limited is financed by 60% equity and the 40% what here somebody gets. Already you can see Sonny Ray has gotten it. Thank you so much. So that is 40, right? Equity is what here somebody 60. Please don't forget our 1 star. .0. I want to see whether there is an online student with go to confirm this. No, 2 decimal places. You have to be consistent. We need to be very, very consistent. We need to be very, very consistent throughout. We shall be very consistent. So we work with 0.92. Let's work with 0.92. We shall be very, very consistent. Even when you are doing exams, we shall not appear to be confused. So that is Bell. After Bell, we know the next guy should be Kel, isn't it? Kel. Kel. So Kel, in this case here, is 3 plus RM or ERM, isn't it? Multiplied by the Bell that you got up there. So what is the risk-free rate? 5. RM is 9. RF is 5. Bell is 0.92. Meaning that Kel will be equal to what here, somebody? Kel. The answer is. One party here. Okay. Decimal places. So the short Stanley was fighting you, right? You shall never fight Lady Stanley. Never. 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 8.68. 8.68. 8.68. So remember, these are percentages. So after Kel, so we have Bell, we have Kel, we put them together through what we call now the Wakaka. But you see, Wakaka, in this case, here now is supposed to be Roman 2, eh? You should always number your questions very nicely. Yes, up there, Isaac, yes. Here means adding back that here. So WACC, so you write like that, you underline. So WACC is weight of equity, cost of equity, weight of debt, cost of debt into 1 minute starts. The only unfortunate thing, because the examiner knows that students fear this area a lot, they give it very few marks. 6 marks like this one. So if you don't get it, so what? They should be going to be given many. Eh? How many marks? How many marks do you want for this question? 10. So if you don't know it, okay. They want 50 there. Okay. atakuwa ameinvest so debt is 60, right? Debt is 60. No, 40. No. Debt is 40. Equity is, and these are given 4%. So weight of debt is 0.4. Weight of equity is 0.69. So weight of equity is 0.6 times cost of equity, which is what here, somebody? Oh, yeah, 8% plus weight of equity 0.6 times cost of debt, which is 5 times 0. Which gave you guys what figure? 6.61. Very good. Ladies and gentlemen, if I continue beyond this point, it will be not very good for us. It will be disastrous, isn't it? But I hope you've learned something, right? If you practice, I'm so sure you guys will be okay. The online guys, have you learned a few things here and there? The online guys, have you learned a few things here and there? Ah, great. Great. A lot, yeah. Great. Great. Thank you so much. See you today in the evening. This is 0 point. Ooh, look at me now. Look at me now. And I'm asking them whether they've learned a lot. Which of them come? It's supposed to be 0.4, isn't it? I think that's the question somebody was asking there. 6.61. So see you today in the evening for advanced management accounting. Bye-bye.